Imagine you have $1,000 and you put it all into PepsiCo. In 10 years, could that 1,000 turn into 10,000? Or will it barely grow at all? We're going to look at the numbers and find out. One day, one stock. Today, we'll look into PepsiCo Inc. Welcome to Stock Snack. All kind of financial numbers could be overwhelming. At Stock Snack, we help to analyze stock, if they are good or bad. At Stock Snack, we help justify it and present it to you. Fast and joy, like having snack. So today, we're going to break it down. Just 4 parts. To get the full picture, first we'll start with the basics. A qualitative analysis. Who are they? What do they sell? Who is their competition? Just the general information. Then we'll look at the business, their different segments. What's their main business? The real moneymaker. And after that, we'll check their finances. A financial checklist. Are they healthy? Are they making money? And finally, the big question, the price. Projection. Is the stock a bargain? Is it worth buying now? That's the plan. Let's get into it. It all started back in 1898, just a pharmacist. His name was Caleb Bradham, and he created something new. The original Pepsi Cola, that's over 127 years ago. But the real story, the modern story that started in 1965, that's when Pepsi merged with another company, a snack company, a little one called Frito-Lay. That was the beginning of everything. The birth of the modern PepsiCo, and they made some big moves. Like in 1997, they had a bunch of restaurants. And they just spun them off. They said, we're going to focus on our core business, beverages and snacks. And they made some big purchases. Like in 2001, they acquired the Quaker Oats Company. And with that deal, they got a powerful brand, Gatorade. Then, later in 2018, they bought SodaStream. That was their move into the at-home market. So you can make your own soda right there in your kitchen. Now, their business model, it's an interesting one. It's what they call B2B2C. That's business to business to consumer. Basically, they sell to businesses like a grocery store or a restaurant. And then that business sells to you, the consumer. And they're a giant. In over 200 countries, and their top 5 products, some might surprise you. At number 1, Lay's, then Doritos. Then the iconic Pepsi, followed by Gatorade. And finally, Cheetos. It's not just a soda company, it's a food company. A huge global food company with a history of big moves. Now, let's talk about their competition. You see, they're in a big industry, fast-moving consumer goods, and that means they have some giants to deal with. First, there's Nestle, a huge company. Their revenue is over $100 billion, and their top product, Nescafe. And, of course, the biggest rival, the one everyone knows, Coca-Cola, their main competitor. They're locked in a constant battle, but it's not just soda. Remember, PepsiCo sells snacks too, so they compete with other big names like Unilever. They sell food, personal care, home products. They're a massive global brand. And then you have Mondelez International. They sell things like Oreo, another direct rival. In the snack aisle, and there's Danone, a French company. They sell yogurt and bottled water, more competition for PepsiCo's beverage business. So it's not just a 2-company fight, it's a huge market, with big players everywhere. And PepsiCo has to compete with all of them for your attention and your wallet. Now, let's talk about the brand, the PepsiCo brand itself. How strong is it? Well, there are a few ways to measure that. You see, some groups, like Brand Finance and Interbrand, they put a value on it. They say it's worth around $20 billion. That's a huge number. It's a really strong brand. But the rankings, they tell a different story. In 2015, they were ranked pretty high, like in the global top 30. But by 2024, the ranking has fallen a bit, to maybe the 90s. Why? Well, maybe the brand isn't as cool as it used to be, but it's still a top player, always a top 2 in its industry. And what about management? They get a lot of praise for being smart, for making good moves, and for giving shareholders consistent returns. So, where are they headed? Well, they have a big advantage. Their portfolio, a powerful mix of brands, beverages, and snacks, and they have a global reach. They're everywhere. But the industry is changing. You see, people want healthier options, and they care about sustainability, and they want things that are convenient. On the go, So PepsiCo's future direction is to lean into that, to focus on health and sustainability, and to use data to get even better at giving people what they want and where they want it. It's a clear plan, and a good one. Now, let's break down their business. We'll look at their different segments and see what's working and what's not. A quick note, the benchmark is 2 times the inflation rate, so if a segment is growing slower than that, it's underperforming. Let's start in North America. The beverage business. You know, Pepsi, Mountain Dew, it's their biggest part. It brings in a lot of money, over $27 billion. But the growth, it's kind of slow, just 3.4% a year, not even keeping up with inflation. But look at Frito-Lay, still in North America. You know, Lay's Doritos. This is a star. It brings in almost $25 billion, and the growth is 5.9% a year. Still a little slow, but it's their fastest growing segment in North America. And its share of the total pie is getting bigger. And what about the international markets? Europe, for example. It's big, over $13 billion in revenue, but the growth is slow there too, just a little over 3% a year. And Latin America, it's a solid business, over $11 billion with a 4% growth rate. Again, not amazing, but steady. Now, Asia. This is interesting. You see, the numbers from 2015 are 0. That's because they used to report it differently. But now, it's a big deal, bringing in almost $5 billion a year, and it's a huge growth area for them. So what's not working? There are 2 big ones. First, the Africa, Middle East, and South Asia segment, the revenue actually went down just slightly, and its share of the company's total revenue, it's getting much, much smaller. And then there's Quaker Foods. In North America, you know Quaker. Oats is their smallest business, and the revenue, it went down over the last decade. It's a struggling segment. So you see, a mixed bag. Some strong areas, and some weaker ones. That's the business today. Now, let's talk about profit, not just revenue, but what the company actually makes, the operating income. First, a quick note. The benchmark is 2 times the inflation rate, so if a segment is growing slower than that, it's underperforming. Let's start with the struggles. The biggest one, North American beverages. You'd think it's a big winner, but the profit went down. Almost a negative 2.1% a year, and its share of the total profit. It dropped significantly. It's a huge problem. And then there's Quaker Foods, the smallest segment and a big disappointment. The profit, it dropped by over 6% a year. The worst performance, but let's talk about the winners. The star of the show, still Frito-Lay. It's the most profitable part of the company. By far, its profit grew by 4.4% a year, and it makes up almost half of the total profit. And then there's Europe. The profit there, it grew over 7% a year. Really strong growth, and a big surprise. Latin America. It had a negative profit back in 2015. It was losing money, but now it's a huge profit center. And a big growth story, a huge comeback. So you see, the profits aren't all equal. Some segments are thriving, and some are really struggling. It's a mix, a real mixed bag. Now, let's talk about margins. What does that even mean? It's simple. It's how much profit they make. For every dollar of sales, the bigger the number, the more efficient the business. So, let's look at the numbers and the trends. We don't have a specific benchmark here. We're just going to look at the growth. The biggest winners, well, let's look at Latin America. It had a negative margin in 2015. It was losing money on sales. But now, the margin is almost 20%, a huge turnaround. And then there's Europe. The margin there, it went from 10% to over 14%, a big jump. That's good. And the new kid, Asia Pacific, their margin is almost 17%, very strong. They're making a lot of profit per dollar. But now, let's talk about the struggles. North American beverages. The margin dropped from over 13% to under 9%. It's becoming less profitable, less efficient, and Frito-Lay. The snack business, their margin went down too. Not a lot, but it still dropped from almost 30% to 25%. And Quaker Foods, the margin there, it was almost 19%, and now it's just 11%, a big drop. So You see, the margins tell a story. Some parts of the company are becoming more profitable, and some are becoming less so. It's a mixed story of efficiency. So, let's get right to it. The big question? What if you invested $1,000 and you just held it for the next 10 years? What could you make? Well, we ran the numbers. First, we looked at the markets. The S&P 500, that's the benchmark. If you put your $1,000 there, it could turn into over $3,200, a gain of 3.3 times your money. And what about this stock? We looked at 3 different ways to value it, and they gave us a range. The lowest projection, your $1,000 would only gain about 0.9x. It wouldn't even double. But our most optimistic projection, a gain of 1.6 times, your $1,000 would become almost $1,600, much better. And so we took the average, to be safe, to be conservative. That average showed a gain of 1.3x. Your $1,000 would become $1,300. So here's the final question. Is it a good deal? Well, to match the S&P 500's return, this stock would need to be trading much, much lower. It's currently at $82, but our projections say it should be more like $67 or $92 or even $107. The price needs to be lower, a lot lower, to get that kind of market-beating return. So is it worth it? You decide. It might not be the bargain you're looking for. So let's talk about the company's financial health. And we'll start with this. You see, we went through 3 main statements in the annual report: the balance sheet, the income statement, and the cash flow statement. And we analyzed multiple metrics to see if it is healthy. We'll discuss the details later, but right now, we'll give you the overview, just to get a top-line insight first. So let's look at the scores. The balance sheet, that's their financial foundation, and it only got a 50% good score. That's a bad sign. Then the income statement, that's how much money they're making. The score was 75% good. That's a good sign. But the cash flow statement, that's their money management. The score was only 25% good. Another big bad score. And when we looked at the big picture, 5 key attributes, the story continued. Their revenue growth, it got a bad score, and the profit growth, a bad score, and the free cash flow, another bad score. But there was one good thing: their debt. It was good. So you see, it's not a perfect financial picture. A mixed bag, some good, a lot of bad, something to consider. So let's talk about the math. How did we get these numbers? The first way was with cash flow, FCFE. That's the free cash flow to equity. It's the cash left over for investors, and we projected it. For 10 years, we looked at a few things. First, the operating cash flow, then capital spending, and finally, the debt. Was it issued or paid off? And after that, we estimated the FCFE per share. We divided the total FCFE by the number of shares we projected. For 10 years later, then we got the FCFE yield. We averaged the results, the latest numbers, and the smallest values, just to be thorough. And from all that, we got the price, the estimated stock price, and it shows what investors would pay for that cash flow. Finally, we added in the dividends, because that's the total gain. For the investor, it's the actual return. Now, the second method, using EBITDA, earnings before interest, taxes, depreciation, and amortization. A mouthful, I know. But we projected it for 10 years, using the 10-year average growth and giving more weight to the latest values. Then, we got the EV/EBITDA yield. We averaged it, and this shows how much a buyer would pay for the company's earnings. And we used that to get the projected enterprise value. And then the projected market cap. We just divided that by the number of shares to get the projected price. And finally, we added the dividends, just like before, for the total return. And the last method, based on dividends. We projected the dividends for 10 years, and we used a rule that the dividend must be less than 90% of the cash flow, the FCFE. And then we projected EBITDA and the dividend to EBITDA ratio and the dividend to FCFE ratio. And we used all of that to get the market cap. We averaged all the values, and we added the sum of the 10 years of dividends to get the final projected market cap. And finally, we divided that by the shares to get the projected price. So, those are the three ways that we got the numbers. Let's talk about the company's foundation, their balance sheet. It tells us if they're healthy or not so healthy. First, the bad news, the debt. Our rule is simple. Can they pay their debt? They only have about 40 cents in cash. For every dollar of debt, that's a bad score. And that's a red flag, and they rely on debt a lot. The benchmark is less than 80%. That's a good number, but their average is over 259%. Way too high. They're funding themselves with borrowing, not with their own money. Another bad score. And they don't buy back shares. They have zero treasury stock. No buybacks? That's a bad sign. It can sometimes mean they're not confident. But now, the good news. They don't have preferred stock. They don't have that expensive extra funding. That's a good score. And their return on equity. This is a big one. The benchmark is over 25%. It shows how much profit they're making on the money investors gave them, and it's over 53%. That's a fantastic return, a very good score, and their return on assets. The benchmark is over 10%. It shows how well they're using their stuff, their assets. It's over 14%. That's also a very good score. And their ability to grow. The retained earnings, the money they keep to grow the business. It's growing at over 4% a year. That's a good sign. So you see, a mixed bag. Not a perfect foundation, but a few really strong points. Let's talk about the company's profitability and its efficiency. This comes from the income statement. How much money they make and how much they spend. First, the good news, their gross profit margin. The benchmark is over 40%. That's a sign of pricing power, and theirs is over 54%. That's a great sign, a very good score. And they don't spend a lot on research and development. The benchmark is under 30% of their profit. They spend almost nothing. That shows it's a simple business, not a tech company, a good score. And their interest payments? On their debt, the benchmark is less than 15% of their operating income, and theirs is low, around 7%. That's a very good score. And they pay their taxes. The benchmark is around 20% of their pre-tax income, and they are right on target. A good sign of credibility, and their debt, they can pay it back quickly. The benchmark is less than 3 years, and theirs is under 3 years. A good score, but there's some bad news. They're selling expenses. The SG&A, the benchmark, is under 30% of their gross profit, and theirs is over 70%. That's a really high number. A bad score, it means it doesn't just sell itself. It takes a lot of money to sell, and their net income. The final profit, the benchmark, is over 20% of revenue, and theirs is just 10%. That's a bad score. It tells us they don't have a huge competitive advantage, not when it comes to the final profit. So, you see? A mix of good and bad. They have pricing power, but they spend a lot to sell their products. Something to consider. Let's talk about cash, the most important thing, not profit, but actual cash, and how the company uses it. First, the good news. The company isn't diluting you. They're not paying employees with a ton of stock. The ratio is tiny, just 0.4%. That's a good sign. It means your ownership isn't being watered down. But now for some red flags, and there are a lot. First, their profit. They report a lot of profit, but the actual cash they make, it's much lower. The ratio is only 0.77. Bad sign. It tells us the profits might not be what they seem, and their spending, their capital spending, their CapEx, it's high. It's over 50% of their profit. The benchmark is a lot lower. A lot of cash is just going right back into the business. That's a bad score, and they're giving money to shareholders. Which sounds good, but the money they're paying in dividends and buying back shares, it's more than the cash they're generating. The ratio is over 100%. They're spending more cash than they have. A bad sign. It makes you wonder, how are they paying for growth? So you see, the cash flow story, it's not a good one. Their profits look nice, but the cash tells a different story. So, what's the verdict? Is it a good investment? You see, we looked at the company from all the angles. We checked the fundamentals, the business itself, and it's a mixed bag. Not perfect, not a complete disaster either. Their balance sheet. It had some serious problems, but their profitability, it had some really strong points. And the cash flow, that was the biggest red flag. The cash is a worry. And the final price projection. The numbers tell us this. It's not a bargain. It's not priced to beat the market. So, in the end, it's not a clear winner. It's an investment with some risk and a lot of questions.